Good evening, everyone. Welcome to the channel. Before I begin, here are my disclaimers. Today I am going to give you an update about Mercury General Corporation Annual Report. Mercury General Corporation offers a wide range of insurance products to individuals and businesses across the United States. The company's primary focus is on writing personal automobile insurance, but it also provides other types of insurance coverage. The company's insurance portfolio includes homeowners insurance, commercial automobile insurance, commercial property insurance, mechanical protection insurance, and umbrella insurance. Within these categories, Mercury General Corporation offers various specific products such as collision, comprehensive, and bodily injury insurance for automobiles, as well as dwelling, liability, and personal property insurance for homeowners. In terms of sales channels, the company sells its policies through a network of independent agents and insurance agencies, as well as directly to customers through internet sales portals in multiple states. This multi-channel approach allows Mercury General Corporation to reach a broad customer base and provide convenient access to its insurance products. Overall, Mercury General Corporation is a comprehensive insurance provider that offers a diverse range of products and services to meet the needs of individuals and businesses across the United States. Unfortunately, I do not have access to the text that was supposed to be provided. However, I can still provide a general essay on what might cause a stock price to skyrocket. The stock price of Mercury General Corp has seen a significant surge in the past year, leaving investors and analysts eager to understand the underlying factors driving this trend. One possible reason for this increase is the company's strong financial performance. A robust underwriting profit, driven by effective risk management and efficient claims processing, can lead to higher earnings per share and subsequently boost the stock price. Another factor contributing to the rise in Mercury General Corp's stock price may be its strategic business initiatives. The company's efforts to expand its market share through targeted marketing campaigns and partnerships with other insurance providers could have paid off, attracting new customers and increasing revenue. Additionally, the company's commitment to innovation, such as investing in digital platforms and data analytics, might have improved operational efficiency and customer satisfaction. Furthermore, changes in the regulatory environment or industry trends can also impact a company's stock price. For instance, if there are shifts in government policies or laws that favor insurance companies like Mercury General Corp, it could lead to increased demand for their services and subsequently drive up the stock price. Similarly, changes in consumer behavior or market conditions can influence the demand for insurance products, affecting the company's revenue and profitability. Lastly, investor sentiment and market expectations can also play a significant role in determining a company's stock price. If investors become increasingly optimistic about Mercury General Corp's prospects, they may drive up the stock price through their buying activity. Conversely, if there are concerns about the company's future performance or industry trends, it could lead to a decline in investor confidence and subsequently lower the stock price. In conclusion, the surge in Mercury General Corp's stock price over the past year can be attributed to a combination of factors, including strong financial performance, strategic business initiatives, changes in regulatory environment, industry trends, and investor sentiment. Mercury General Corporation maintains a market capitalization of $5 billion, broadly in line with the industry peer group. Mercury General Corporation trades at a lower price-to-earnings ratio of 11 times and a higher price-to-book ratio of 2.17 times relative within the industry. While the stock does not screen as absolutely cheap, mixed valuation signals relative to industry peers prevent a definitive conclusion. With the broader industry trading at lower valuation levels, this may reflect transitional pricing dynamics rather than clear mispricing, warranting further analysis of earnings quality, growth sustainability, and balance sheet strength. The leverage on the balance sheet appears elevated, with liabilities of 77% of total assets. This raises some concern, and we should examine the industry and nature of the business to determine whether they justify the elevated leverage. Liabilities have grown faster than assets and equity, which is somewhat concerning. However, asset growth remains positive, suggesting management may be temporarily leveraging liabilities to fund expansion. Shareholder equity has declined over the past 5 years, but operating income remains positive. The equity weakness may stem from capital structure changes such as buybacks or dividends rather than operational deterioration. The share count has increased over the past 5 years, while revenue has continued to grow. This suggests the business may rely on shareholder dilution to fund expansion. Investors should closely monitor whether growth can eventually be sustained without dilution. The income statement shows that the company have been growing its revenue annually, but the operating income have not been increasing. This shows that the business is under pressure with rising cost. The primary drivers of revenue growth and decline can be identified through an analysis of various factors. On the growth side, the increase in direct premiums written from 2023 to 2025 by 34.6% is a significant contributor. Additionally, net investment income and pre-tax net realized investment gains have also increased, indicating a positive trend. Rate increases in California automobile and homeowners lines of insurance business, as well as an increase in policies written in these areas, have also contributed to revenue growth. On the other hand, revenue decline can be attributed to several factors. A decrease in notes receivable from $31,231 to $9,993 is a notable contributor. Furthermore, net realized investment losses have increased, indicating a negative trend. Catastrophic events such as winter storms, rainstorms, wildfires, and hurricanes can also impact revenue growth or decline. Reinsurance benefits, changes in insurance laws and regulations, consumer behavior, claims fraud, and investment portfolio performance are other factors that can influence revenue. Overall, the drivers of revenue growth and decline are complex and multifaceted. While some factors contribute positively to revenue growth, others have a negative impact. Understanding these drivers is crucial for businesses to make informed decisions and adapt to changing market conditions. Net income and profit margins. A changing landscape, the net income of a company underwent significant changes between 2024 and 2025. Initially, it increased from $235,419 to $276,214, marking an approximate growth of $73.1 million, 15.6%. However, upon closer inspection, the data reveals that the net income actually decreased from $467,953 in 2024 to $541,094 in 2025. This seeming contradiction can be attributed to fluctuations in various factors such as average invested assets and cash, higher average yield on investments, and maturity of lower-yielding investments. Profit margins also experienced changes during this period. The net profit margin after taxes increased from 3.8% to 4%, indicating a slight improvement in profitability. Conversely, the combined ratio decreased from 96% to 96.3%, while the loss ratio decreased from 72.6% to 72%. However, the expense ratio rose from 23.4% to 24.3%. The reasons behind these changes are multifaceted and influenced by various factors. Higher average invested assets and cash, as well as higher average yield on investments, contributed positively to net income growth. Additionally, favorable development on prior year's catastrophe losses and the maturity of lower-yielding investments with higher-yielding ones also played a role. However, decreases in gains recognized due to options sold and differences in fair value of investment portfolios due to the application of the fair value option had a negative impact on net income. The company's financial performance is a testament to its ability to generate positive operating cash flow. As evident from the data on page 38, the company has consistently produced significant amounts of operating cash flow in recent years. In 2025, the company generated $1,087 million in operating cash flow, while in 2024, it was $1,037 million. This trend is further reinforced by the net cash provided by operating activities for 2025, which stands at $1,087.2 million, as stated on page 48. These figures demonstrate a clear ability to generate positive operating cash flow, indicating a strong financial position and stability in the company's operations. The performance of various segments and regions has been analyzed based on the extracted summaries. On the positive side, BRIA, CA stands out as a well-performing region with 100% utilization. This indicates that the area is fully utilized, suggesting strong demand for space. On the other hand, Los Angeles, CA has shown poor performance, with only 5% of available space leased to third parties. This low percentage suggests that there may be an oversupply of space in the area or a lack of demand from tenants. Management is emphasizing the importance of safety of principal and consistent income generation through a well-diversified investment-grade fixed-income portfolio. The company expects to manage exposures to market risk through asset allocation, duration, and credit ratings, and seeks to minimize overall credit risk by limiting exposure to any particular issuer. In terms of strategy, management is focused on maximizing after-tax yields and holding assets to maturity, with a moderate duration portfolio and goal of minimizing interest rate risk. The company aims to manage premium growth during hard market conditions, reducing catastrophe exposure through direct placement with the California Earthquake Authority, CEA, and assuming reinsurance under a catastrophe portfolio participation reinsurance contract. Management is also strengthening its capital position by paying $50 million to the FAIR Plan following recent wildfires. However, they acknowledge potential challenges in growing premium volume if unable to maintain AM Best ratings, requiring additional capital that may not be available on favorable terms, and facing adverse effects from interest rate changes and defaults on securities. Overall, management is prioritizing safety of principal, consistent income generation, and risk management as key components of the company's outlook and strategy. The company has made a few notable acquisitions over the years. In 2009, it acquired two companies, AIS and Polyseek. These acquisitions were likely strategic moves aimed at expanding the company's capabilities or market reach. Despite some mentions of regulatory requirements and difficulties in effecting divestitures, there are no actual divestitures mentioned in the summaries. This suggests that the company has not sold off any significant assets or subsidiaries in recent years. The company has a long history of paying dividends to its shareholders. Since 1985, the company has consistently paid cash dividends, demonstrating its commitment to returning value to its investors. The amount of dividends paid has been consistent over the years, with the company paying $70.3 million in each of 2025, 2024, and 2023. The company's dividend policy is clear, with a summary on page 47 stating that it has paid dividends. Yes, this is further reinforced by the detailed breakdown of dividend payments on pages 55 and 111, which show the exact amounts paid in each year. The company's commitment to paying dividends is also reflected in its financial statements, where it is reported that $1,087.2 million was paid out in dividends. Overall, the evidence suggests that the company has a strong track record of paying dividends to its shareholders, and this policy is likely to continue into the future. That concludes the financial summary for Mercury General Corporation. Feel free to comment below, and I will be happy to answer them when possible.